Hello and welcome to Bondcast, the podcast series where we discuss our views on the latest themes and events shaping bond markets. I'm Giles Gale, European rate strategist, and today I'm joined by our global market specialists, Jan Nevruzi and Ross Walker. Jan, we're going to start in the US this week. So we got the inflation number, which showed yet another acceleration. What is going on with that?
Yeah, Giles, I mean, that's definitely a troubling read both for the Fed and for the economy. We saw a little bit of a dip in July before the previous month's read, which turned out to be a little bit of a head fake because, like you said, inflation accelerated again in August. I think the more troubling part of what goes on within the index were that some of the traditionally more sticky components, such as rents and other shelter measures and education, they all showed very firm reads, which implies that even going forward, the path of how quickly inflation can fall looks a little bit more, I suppose, elevated. When you have rents and coming out like 0.7, 0.8 on a monthly basis, it's highly unlikely that they would half the next month. They are a little bit lagged, and they use some form of survey measures that might not necessarily reflect spot rents. But that being said, the Fed has been reacting a lot to the realized inflation, which I'm sure we can kind of make the point for other central banks as well. The Fed has been reacting a lot to realized inflation, and getting a 0.6 reading core was much higher than what most analysts, including us, expected for this month. I think the main implication is that everyone has to raise their profile for next year inflation expectations and potentially even beyond. And that obviously has huge implications for monetary policy and potentially fiscal policy should an economic downturn come.
All right, so these enormous consequences for monetary policy brings us on to the obvious next question, which is, how does that affect your Fed view? Have you changed your outlook?
We did, and we did change it quite dramatically. So we now expect a 75 basis point hike for the September meeting to be followed by another 75 in November, and then a small step down to 50 basis points in December. And tentatively, we have another 50 penciled in for the first half of next year. Of course, what happens next year is a little bit of a lower confidence view compared to what we think will happen over the next few months. Even that, given the inflation readings, has the high confidence should be taken with a grain of salt, because now markets pricing a little bit of 100 for the Fed, which at some point you would think the law of large numbers has to kind of kick in and stop these increases to materialize. But I mean, our base case will be 75 going to the meeting. There's two big caveats there. We could have a similar release to a leak to a newspaper like we did in June. Since the Fed is now in a blackout period, they can't go out and explicitly comment on what they think they should do in response to the inflation number, but they could kind of give, I guess, hint through some form of reliable newspaper that they're planning on doing going through a certain amount of direction. That would help markets price in a more firm 75 or 100. And when I say 100, we're still close to 25% pricing. So it's not really an overwhelming majority of market participants think that it's going to be a 1 percentage point hike, but rather it's more of a kind of what feels like a tail hedge buying there. And the other thing is, of course, if that tail hedge buying moves into participants more overwhelmingly believing that the Fed can go 100, they might as well just take the free option if it's given to them. I think that raises a lot more questions than answers, because it kind of leaves them it leaves the Federal Reserve in a spot to decide what follows 100 basis point. Is that stepping down back to 75? Is that kind of one of those things that you do to pull off the Band-Aid as sharply as you can in order to front load as much as possible right now, and then stop at the end of the year, stop in November? So like I said, a lot of questions, and it will be certainly a challenging meeting for the Federal Reserve. And of course, they can come up with a very specific plan, but I'm not so sure they have a very specific plan right now. This last inflation number definitely threw a wrench into the equation. And if there was any trend of deceleration or kind of like moving towards target, that has completely reversed now.
Okay, so essentially what you're saying is that the Fed sounds like it's got its work cut out for it. I mean, I guess for longer term rates now, the question becomes, does this really change anything? Obviously, in the short term, we've got this this tussle between a pretty strong inflationary economy and the Fed that wants to knock it down to size. I guess that we assume that it'll be successful eventually. It's just the number of punches it needs to throw in a sense.
It is all transitory depending on your timeline.
So yeah, just give us a sense for how that's making you change your view or not on longer term rates as well.
Sure, and I mean for the shorter dated yields, like I said, it's fairly obvious what the Fed does, the front end follows. So that's pretty much chasing immediate Federal Reserve action over the next year or so. But for down the line, call it like 10-year yields, post CPI, we describe what we see is influencing that part of the curve, and even further out, 30-year and so, as two opposing forces. Upward pressure in yields that could come from the obvious fact that the Federal Reserve will raise rates to a lot higher levels than most people previously thought, which in turn obviously creates this environment where should a cutting cycle come, they don't necessarily have to go as low again. Odds are that if you push rates to 5-6%, the next time you cut, you're not going to go down to, or you could go to 0%, but odds for that are lower compared to if you finish your hiking cycle at 3 or 4%. So that could, in a sense, set a floor to real rates. However, from the other side, we think that as the Fed doubles down, as the Fed ups the ante, you get to a point where the shallow recession that we expected is now turning into more of a more protracted and deeper recession as well. And that in turn also brings lower productivity growth, lower business investment, and just generally you end up in an environment with potentially even larger cuts as the recession becomes more protracted and more deeper, like I said. So it could be the average cutting cycle, excluding 2018 and to 2020, including COVID, when they couldn't really lift off that much, has been around 5 to 6% in Fed funds rate. So if we have a severe economic downturn and which brings inflation under control and creates these disinflationary headwinds, I don't see a reason why the Fed couldn't necessarily return back to the lower bound at some point. So I don't think we should have a kind of like a level that the Fed would consider as like we're not going to breach below. Yeah, we don't see them going below neutral anytime over the next year or anything, but we're talking about a 10-year instrument. So probabilistically, I don't think the Fed Fed hiking a lot more today means that those yields should go much higher as well. So in fact, our view is that the 10-year yield 10-year treasuries will finish the year at lower yields than where they are now.
All right. Well, I've certainly had my doubts, but I shouldn't have, because that seems to have been roughly the playbook for the week. Okay, thanks very much, Jan. Ross, it's over to you now on the UK. Now that you've had, I guess, just over a week to reflect on Liz Truss's big energy announcements last week, how's that changed your forecasts for the key growth and inflation path?
Yes, well, this is a substantial fiscal intervention. We don't yet have the formal costings. Those we think will come next week in the mini budget or fiscal event. And of course, ultimately, they will depend on what happens to wholesale gas prices. But the indicated sums are about £150 billion over 2 years. So £75 billion a year, 3% of nominal GDP. So this is a substantial pandemic era scaled fiscal support. It certainly pushes back against fears of a deeper or more prolonged recession. Provisionally, I think now we're looking for positive rather than negative growth in 2023 and 2024. Nothing spectacular, but 0.25% perhaps in 23, maybe up to 0.7, 0.8% in 2024. So materially better than the prior scenario, where essentially those GDP numbers had negative signs in front of them. So it feels like a huge intervention. It's over a 2-year period. It's going to provide significant certainty. Of course, we will still have had a doubling of domestic energy prices since the period just before the Russian invasion of Ukraine. But nevertheless, alongside that, there was also some prior financial support, £400 for every household, additional funding for poorer households on means-tested benefits. So there is a significant degree of protection for the UK households versus the position prior to this announcement.
Okay, and so with that in mind, then thinking about the Bank of England that pushed its meeting into next week, of course. How do you think that they'll be weighing all this up in the risks for the economy, do you think? And I'll just mention that the market price is roughly 60-40 for a 75 basis point rate rise next week. Does that sound about right to you? And then looking a little bit further ahead, the market has about a peak of about 4.4% in bank rate at the moment for the middle of next year. Do you think that we can possibly get that far?
So in terms of next week's meetings, we're still in the 50 basis point hike camp, where most economists appear to be. As you say, markets continue to price in a bit more, though interestingly, market pricing hasn't really moved dramatically since that fiscal announcement. But the markets were always pricing in a much higher probability of a 75 basis point move. In fact, given the scale of that fiscal announcement and given how much markets had been moving in response to, frankly, second-tier data or speculative headlines, it strikes me as absolutely extraordinary just how little rates markets have moved in reaction to this announcement. If anything, I mean, I think the fiscal stimulus on that scale and for that length of time must put some additional upward pressure on policy rates. Whether the BOE feels compelled to step up the pace again, of course, they moved from quarter-point hikes to half-point hikes at the previous meeting, to move immediately to a 75 basis point hike, in some ways feels quite radical. They may also want, because we haven't yet had the full details of these fiscal measures, they may also want a bit more detail and the benefit of one of their quarterly forecast rounds. So perhaps the bigger risk in terms of if a 75 basis point move is coming, or if the BOE moves to that faster pace of tightening, that perhaps that begins in November in the context of a full monetary policy report forecast round. But the terminal rate, we've revised up our forecast to 3.5% in February from 3% in December prior to the fiscal announcement. That is still a substantial amount of tightening in our view, and certainly given the limited pass-through from bank rate to actual debt servicing costs for households. So I think the jury is still out on, whether the BOE has to move, as you say, another 100 basis points beyond that. And if it does, whether it has to move as quickly as the market's pricing. So I think I've always been more open to the idea that the eventual terminal rate will be a bit higher because there just turns out to be more embedded inflation domestically. I'm not sure whether that will be sufficiently clear to get us to 4.25%, 4.5% as soon as next spring. So I guess we continue to push back a little bit against market pricing, though we have done that for several months, and events have, I think market pricing has been more vindicated than our original forecast.
All right, then, moving on to Europe. So, Giles, well, the ECB has been converted to, I guess, front-loading interest rates when you have someone like Philip Lane sounding pretty hawkish. So the market's looking at an 80% probability of 75 basis points next month, and perhaps a total of about 60% probability of 150 basis points over the last 2 meetings of the year. Is 75 basis points going to be the new normal for the ECB?
Well, okay, so my simple answer is no, I don't think it probably will be. I think it's probably what they will do next month. That has been our call for several weeks now. And I think that the fact that someone like Philip Lane, who before the meeting, remember, seemed to be leaning more towards 50 basis points for the last meeting than the 75 basis points that was actually delivered. The fact that he's now essentially portraying that as a logical, sort of sensible step, clearly indicates that they would be more inclined, I think, to take another large step in a similar sized step at this next meeting. So I think that is still your very firm base case. Whether that means more than 80% or not, I'm not so sure. I think 80% is probably about right. So I'm sorry to sound a little bit bland in my assessment there. Obviously there's another month and things can go wrong. I think that's obviously 50 basis points is more likely than 100 basis points, although that's that could also come under review depending on data, I suppose, and other events in the meantime. But I think that if I'm really pushed, I'd say that 50 basis point rises in October and November and December are more likely than 2 times 75, for example. But I don't think that the market pricing is particularly far-fetched, if I'm honest. Clearly, they are looking at closing the gap on neutral as fast as is reasonably possible, and having just done 75 and not really having caused any significant difficulties for the market, I don't really see why they wouldn't try to close that gap at a similar pace. And then the question of whether after that we're talking about 25 or 50 or possibly even more, I guess that maybe things are looking more like 50 basis points, but our base case is still 25 for that December meeting.
And moving on a little bit into the plumbing of the European markets, the demand for collateral or cash or whatever we want to call it has been an important topic and recently a headache for the authorities. What's your kind of view on that? What's going on?
So this is probably something that requires a whole separate Bondcast special or something on. But no, just very briefly, I think the way what seems to be happening at the moment is that, as we've spoken about before on Bondcast, I think that there is a substantial demand for cash anyway. I mean, there was pre-existing, and that was always visible in market rates, which for the highest quality stuff was always solidly below the deposit facility rate. That's kind of been accelerating as a theme throughout the year, and you can see that in various instruments. German repo is an obvious one, and there's no real reason to think that is getting any better. And as we get towards the year end, there's always a little bit of an excess demand for good quality collateral into year end anyway. And I think that the lessons that people are drawing from the last couple of years is that you have to get ahead of that. So I think that is probably that's one theme that's likely to be there in the background. Another thing that's possibly in the mix is this question of collateral to back margin requirements for energy in the energy futures markets, which is something which is being reviewed by the Commission at the moment. So in the announcements that followed von der Leyen's State of the Union speech yesterday, there was a little bit of a timeline for the work stream that is looking at that, and in particular, the ESMA is going to report back next Thursday, 22nd, mark that in your diary, on possible changes to the way that collateral is posted and so on in those markets. And then the following week, the EBA is going to be reporting on how collateral is transformed into cash in the banking sector in order to make those things available. Anyway, so lots of things in the mix there. We're talking about serious amounts. I mean, that's about 1.5 trillion according to some media reports. So any significant changes there would potentially be quite important for the demand for cash and collateral, and potentially easily on the scale of any sort of year-end demand as well. So there's a lot to consider there. There's also a fairly significant question about the role of the ECB in the way that it's trying to manage its the excess liquidity which drains back through the banking system. This whole issue of paying too much interest to the banks that we discussed last week, which could potentially, I think anyway, result in or end up with the ECB looking at ways of maybe draining or sterilizing, however you want to call it, some of those that excess liquidity, or making it available to the non-banking sector as well, and that may, depending on how it's designed, provide extra collateral for all these other things. So there's a lot of things to monitor, I would say.
Nice. And to finish up today's discussion, the other focus recently has been energy policies in the euro area. What are you making of this week's announcements, and what do you think the implications there are?
Well, broadly in the same line as what Ross was saying about the UK, but just in a much, much, much more modest way. Clearly, the Commission doesn't design anything that actually involves taxation. So that's not what they were doing. They're more involved in kind of trying to figure out how to redesign the energy markets, and that is going to take a little bit of time, but I think that is broadly on the right kind of track and should result in eventually sort of more controlled and less volatile energy prices across the board. But clearly to retail, that's going to matter. But also, having delivered that, it opens the way to measures at the nation state level. So that's where things like, fiscal measures like energy price caps and so on can be put in place. And we saw that yesterday. Was it yesterday? Yes, I think it was, from France, yesterday, Wednesday, just for the avoidance of doubt, from France, which raised its, what do they call it, the energy price shield by 15% for the year, which, is not unwelcome for I suppose many French consumers, but 15% is pretty moderate in the context of what's been going on in energy markets. So that, I think, would be should be pretty supportive for activity and consumer confidence there. Obviously, a week ago we had a third round of sort of fiscal measures to try to protect households against this energy shock in Germany, and there could be more there as well. And I think that there will be more from others in the pipeline. So overall, I'm taking this as an additional sign that my assessment that we're not headed for an out-and-out energy crisis this winter, which I've been repeating for a couple of months now, is tracking reasonably well. Okay, that's all we have time for today. Just a reminder that if you enjoyed today's episode, please hit the like button and subscribe so that you can get the latest episodes as soon as they're available.